Yeah. So basically what we're kind of telling people is, hey, we went through and we looked through some of your old leads that you've done with us, UWM loans, right? And we went through and we kind of picked out those which were at 365 days or further. Although really speaking, you could look at 335 days or out because let's say that there's a 30-day lock period, right? It's simply that there needs to be a 365-day seasoning from note date to note date. So we looked at some of those loans and we said, okay, these are loans which are at like 6.999 or above on the rate. They're at 365 days or more from their note date. Let's go ahead and let all of our brokers and LOs know, hey, we have these leads in our system. We have this product. We think this could be a really good opportunity for you to look into and see if it could be a good opportunity to do a refinance with Refi 100. So I actually called Andrew yesterday because we had one of those for him. I think it was around 7.512 or 7.516 for his borrower and about 400 days from the note date. So it could be a really good opportunity to do a Refi 100 refinance. Now, it's also possible for you to look at some of your past loans with us. If you go to uwm.com, right, and you go on the resources tab and you scroll down to Insights Dashboard, this will actually bring you to a dashboard which shows you the past loans you've done with us. You can filter them by the type of loan, loan amount, the rate, time period, so on and so forth. I'm not going to click on it right here because I have different accesses and it'll bring me up all of the ones for all of my different clients and brokers and LOs. But this is a really good opportunity, or what's the word, resource for you to take a look at some of your past loans and see if they are going to be good opportunities for this. Now, once again, when it comes to refinances, it's not just an opportunity for you to look at your past clients and try and reconnect with them and refinance them. You can also look at new clients, right? There are a lot of different tools out there. Like, for example, we just partnered with a service called Property Radar. And there's also another service you can play for called, let's see, I believe it's called, what's the word? I need to double check what it's actually called, but I know that probably as realtors, you have access to something similar to it, where essentially you can look at a certain area and you can kind of filter out all the different loans that people have, mortgages that people have within that area for those houses. You can filter out what type of program it is, so conventional. You can, and then it'll show you what rates they have, right? So if you're able to find these, and it'll also provide you with some basic contact information if they have it for the actual borrowers on those loans. So if you're able to find this information and you see any loans that are 7.5 or higher, I mean, we've been looking at some of them. I've been looking at some of them with some of my brokers, some of whom are in California, and you'd be surprised what rates people have on some of their conventional mortgages, right? They have up to 10% sometimes. So it's a really good opportunity. And honestly, sometimes these programs can be a little bit expensive. If they're month to month, they can be something like $60. If they're, a year, they can be something like, 600, 800, 900. If you're able to get one loan off of that, it more than pays for it though. So that's just something to keep in mind. Um,
Hi, Sat.
yep,
Some of those loans that are super high, a lot of those are private loans, like non-QM loans.
you're right. You're right.
So I got one like that the other day, and I'm wondering if they didn't qualify then, how are they going to qualify now for a traditional loan?
It depends. Hopefully, hopefully their financial situation has changed. Hopefully, they are more qualified now than they were. In some cases, they aren't going to be, and that's kind of the nature with leads, right? You'll find a bunch of leads out of all of them. Maybe a few of them will be qualified, but those few can net you thousands of dollars, right?
Do you put them
Um,
back in do you put them back in the non-QM? You guys offer non-QM products, right?
we do offer non-QM products, right?
So then I could do a refinance on another non-QM to get like maybe an 8, I don't know, from a
You could
10.
potentially, you could potentially.
Okay.
Um, But the one thing to note on that is, once again, Refi 100 is only eligible for conventional rate and term refinances.
Got it. Got it.
So you can still refinance those, of course, but for Refi 100 purposes, that wouldn't be eligible.
I have a question.
Yep.
On the refinancing a UWM loan, how many days did you say?
365, so 1 year from note date to note date. So you can start the process, right? You can import the loan. I think it has to be at least 30 days. So I think once the loan reaches 335 days from its last note date is when we'll allow you to submit the loan. If you want to do it a little bit early. But let's say you can like import the loan and submit it while it's still at 355 days or 360 days, as long as the note date for the new loan isn't before that 365-day period. I mean, they won't let you put the note date for that loan before the 365-day period.
But I have one in now that I'm redoing, and it's only 210 days. So you're telling
Right.
me I need to pull that loan.
Well, if you would be able to still refinance it. It's just it wouldn't be applicable for the Refi 100 period, Refi 100 program.
Oh, okay. So it's okay to redo it. Okay.
Yeah,
Okay.
you can refinance. Well, actually, let's see. There may be that 12-month seasoning period on the thing. Who's talking right now?
Oh, this is
Still.
Philip.
Phil? Okay, I'll give you a call afterwards. And we'll talk. But 1 second. Actually, Phil, give me 1 second. Yeah, let me call you afterwards and we'll talk specifically about your situation, your scenario, and we'll see exactly what's going to apply to it. But
We all want to know.
well, too bad. I'm not telling you. No, I'd have to double check that real quick. So I can actually, I can send out an email after this meeting or later today. If anyone has any questions that I'm unable to answer right now, I can write them down and send out those video emails I send out almost every day. I can send out one of that to everyone who attended the meeting and kind of going over resolving any of those questions.
Awesome. Yeah, man.
But yeah, couple other things we have just real quick. Sorry, go ahead.
I have a question on that that Refi 100. Since it's a UWM loan, is it going to be reduced documentation or free appraisal or anything like that? Since it's going back into UWM?
No, I don't believe so.
Okay.
Sorry. But I will double check on that, but I believe the answer is no.
I don't think that, I mean, for documentation, it sounds like you're talking like a streamlined type of loan, but that's a completely different underwriting process. But yeah, that would be cool. But
I agree, it would be cool.
I'm okay
not
with
the
100.
one.
100 bips is worth a full doc refi for me.
Yeah, I mean, that's my thought about it too. I mean, who knows? If I was the one who set policies, maybe, but let's see. So besides Refi 100, there are a couple other different programs, we've put out in the last month or two that are kind of running right now. One of the top ones I'd say, which I've seen people using, is our temporary 1.0 buy downs with a $600 appraisal credit. So if by March 31st, you lock in a loan that's using a temporary 1.0 buy down with us, so that means that for the first year of the loan, they are paying 1% less than the note rate, and the second year onwards, they're paying the full note rate. We're going to give you up to a $600 appraisal credit on the loan. So for most appraisals, that's going to come off as covered. But a couple of things to note with that is the reason why we chose a temporary 1.0 buy down and no other type of buy down is because we figured, hey, rates are still a little bit high. Kind of everyone's expecting them to fall, at least be a decent amount lower by the end of this year. So they're probably going to refinance it at the end of this year. If they're doing like a lender paid LLPA 1.0 buy down, then they're going to just lose the extra money that they put into that, right? But So that's why we've only kept it at the 1.0 buy down, because we figure, okay, they'll do 1 year with the lowered note rate, 1% less than market rate. And then at the end of that year, you can go back to your borrowers and just refinance them for whatever the lower market rate will be.
So, question on that, Sat.
Sure.
Where does the buy down money come from? Did you say that the lender can pay for it?
So it's when we say lender paid, it basically shows up on the price of the loan as an LLPA. Well, so the two kind of like possible vectors for 1.0 buy downs and who can pay for them is either seller paid or lender paid, right? Now, lender paid is actually borrower paid. The borrower ends up paying for it. It gets put on the loan as a loan level price adjustment. But seller paid is also still an option there. So if you do have seller concessions, it might be a good option to, see if, you could use some of those towards a temporary 1.0 buy down. Then you get an additional $600 appraisal credit on top of whatever you're getting for seller concessions. And the good thing about seller concessions when they're paying for a temporary 1.0 buy down, or for any buy down for that matter, is if you decide to refinance the loan while you're still in the period of that buy down, let's say you're at maybe a 2-1 buy down, right? And at the end of the first year, you decide to refinance the loan. Whatever money is left over for that second year that the seller paid will automatically go into reducing the principal amount on the refinanced loan. Now, if it is a lender paid and it's just an LLPA, then unfortunately, no, there's no excess money there. So what I have seen some of my LOs and brokers do is they will select a slightly higher rate than par to give them a little bit more lender's credit on there, right? And let's say that takes them from like a 7 point, let's say a 7.0 to maybe a 7.2 or even a 7.3, right? Then they'll put that 1.0 buy down on there. The excess lender's credit will cover that LLPA, which for a 1.0 buy down, it is an adjustment of 0.875. So they're able to get 0.875 more credit, and then their borrower will still be paying 1% below that amount. So let's say a 6.2 or 6.3, where before they would have been paying a 7.0, right? And for that first year. And at the end of that first year, they'll just go ahead and refinance that.
Okay. So I didn't realize that a lender you could do any type of lender paid for a buy down. Is that common?
Really, honestly, I'm not quite sure what other companies are doing.
But
I know that
all your buy down options can be lender paid.
yes. So if we actually look in here, I'm going to go to Easy Qualifier.
Awesome, let's do it.
And we can actually see that if we choose buy down type, you can see all of our different buy down types have an LLPA option, which is the lender paid option. If you select the regular buy down type, you can see that it doesn't have LLPA there. That means you're choosing, this one's going to be seller paid, right?
Okay.
If it has LLPA, that's the lender paid option.
Mm-hmm.
So you can see that, yeah, we have a 1.0, 1.1, 2.1, and 3.2.1 available as our buy down options. All of them have lender paid options there.
Wow. Okay. And then so that shows up in the rate, or does it show up in closing costs?
So it shows up as an adjustment on the loan.
Okay.
So it will show up. It technically doesn't add itself to the rate. You would manually adjust the rate to fix it. But like if we're going back to the, give me 1 second. Sorry, this zoom bar up here is actually, move it a little bit. So if we're going back here, let's see if I can actually find it right here. So you can actually see what the adjustments are right here. So just like any of the adjustments we added on in this kind of period here, it gets added on as an adjustment. So if it's a 1.0 buy down, conventional 30-year, you can see that's an adjustment of 0.875. If it's a 1.1, then 1,500. 3.2.1, sorry, not 1,500, 1.5. 2.1 is 2.375. 3.2.1 is 4.5.
Got it. Okay. Huh. Interesting. That's like that. I didn't realize that most just have seller or realtor credit. So that's pretty cool.
Yeah, of course. Let's see. Another thing to note is, and I know I've talked with you a lot, or a decent number of you about this program already, but the Fannie Mae Home Ready SPCP program, the Special Purpose Credit Program, that has just had its name changed by Fannie Mae to the Fannie Mae Home Ready First. So it's no longer Fannie Mae Home Ready SPCP, it's Home Ready First. And once again, this is just a decent option for you to take a look at. This is for at least one of the borrowers has to be a first-time home buyer. And this program takes into account where they currently live, not where they're looking for the property. So in California, where they have is kind of the Riverside, San Bernardino, Ontario area, that's what's covered by this Home Ready First program. And if the borrowers live in this area and they are a first-time home buyer, then pretty much they're going to get $5,000 towards their down payment, $500 towards an appraisal credit, $500 towards a 1-year home warranty credit, and they have to fit other home ready guidelines for Fannie Mae, except for the income limitations. So that 80% or below county AMI limit that you would find on most home ready loans doesn't apply to Home Ready First. So that's something to know. It's supposed to be a program to help those in underserved communities. And so if you actually search it up, there are kind of like lists of what in each state, which exact areas are served. So California actually has those. And let's see if we can actually find one sec, because I know when the dashboard was originally put out, it's here, but I think it's probably going to be over here now. One second. So if we go to the source and search that up, it'll take you to the eligibility lookup tool, where you can actually, I'll have to log in. And once you're logged in, you can actually put in your borrower's current address, and it'll let you know whether it falls under the eligibility for this Home Ready First program. Now we can see that in our site, it's still listed as Home Ready SPCP. That's because this change has pretty much just gone through, at least on the tool it is. Here you can see it's listed as Home Ready First. I think they're probably going to try and change it on the tool soon. But if you search SPCP or Home Ready First, it should come up and allow you to get to this tool. All right. Any questions?
No.
Okay. Well, I think I am coming to the end of my time, and I've talked about most of what I want to talk about. So if anyone does come up with any questions, please feel free to give me a call or email me. And actually, yeah, try emailing me first so that at the end of everything, I can kind of compile it and maybe send out those video emails at the end of the day. All right. Well, in any case, otherwise, thank you so much for having me. I'm glad I was able to, hopefully get you a little bit more familiar with using the rate sheet to price out loans, and hopefully get you a little bit more familiar with some of our recent offerings as well. Once again, if you have any issues on anything, you have any loan scenarios you want to talk about, any questions on a current loan scenario, give me a call, shoot me an email. We'll talk about it and we'll get you fixed up, okay?
Sounds good.
All right.
All right. Thank you.
Thank you very much, Andrew, Gavin. Thank you for having me. Is there anything else you need from me?
No, not for me.
Sorry, it's Andrew Travis. I think it's Andrew Gavin instead of Andrew Travis. But okay. Well, then I will hop out. I have another meeting I have to head to real quick. But I hope everyone has a wonderful day. Please stay dry, avoid the rain, and I will see you next time. All right.
That later.
Bye.
Right.